Wow, that was a
right.
pretty. Usually I complain the music's not that great. That music was really, really good. Welcome everyone to.
I almost jumped out of my seat when that orchestra hit. I was like, "Oh my god!" I was like, "I'm not gonna be asleep tonight."
Yeah, you're easily scared. We'll talk about that. But happy Halloween, everyone. Happy Diwali. Is that the start?
Too?
Yeah. We are excited to be here, Ryan and Sonu. We've got Neil in the, I guess we'll call it the green room. It'll sound like we know what we're talking about. Neil's in the green room, going to join us in a second, but this is a special Halloween live stream. And Sonu, we picked an interesting day because markets are down. I guess it's a little scary.
And, I feel like I'm talking to the right person. I'm talking to Tom Lee here.
Yes, and Tom, I am Tom Lee for Halloween. I've got another costume or two that I'm going to wear. Where's Skelly? There's Skelly. Let's talk about Skelly behind you, and then we'll bring Neil in.
There he is. Skelly's my, I brought him from the outside. He's usually outdoors during Halloween season. I was like, I may as well bring him in, get into the Halloween spirit. I have my Diwali vest. I have everything going on here. I have some fuel for the next 1.5 hours because Kelly is holding some candy for me too.
I messed up there. I didn't bring any fuel, but we are really excited. Again, I think some people will hopefully listen to this, on the Facts versus Feelings podcast. A little bit later after we do this, but we are doing this again live on Halloween. I guess first things first. You just want to bring Neil in? I guess that's what we'll do, right? I mean, that's what people are here for. They're here to see Neil Dutta. Let's go ahead and bring Neil in, Chelsea, please.
I think there's a surprise there.
Yep.
All right.
There he is.
Neil.
Hi, guys.
Hello. So, Neil, what are you for Halloween there? First things first.
I'm doing a mashup. I'm going as Diwali Ken.
Love the vest.
So just like Sonu, I have my Indian vest, and then I have my Ken tank underneath.
There you go. I love the little armbands or elbow bands. All those things. Is that?
I don't know. I mean, it's like an 80s thing, I guess.
So we should do titles, right? Neil, you want to go ahead? Title, and everyone knows who we are, but for compliance purposes, we need to do title.
Oh, sure. I'm managing director, head of economics at Renaissance Macro Research.
So again, we're excited, Neil. You're here. We'll start going with some questions soon. We originally kicked off the idea of doing a live stream. I guess it was on not President's Day. What was it?
Leap Day.
Well, we did Leap Day, but then we kicked around maybe Columbus Day, Indigenous Peoples Day, and that didn't really work out. And someone said, "Let's do it on Halloween." We're like, "Yes, let's do the live stream on Halloween." That kind of made a ton of sense. I mean, before we even get there, Neil, what are the plans tonight in the Dutta household with the kids?
Well, the kids have their school parade, so we're going to be going to that later in the day. One of the benefits of working from home, you get to sort of partake in these activities. And then we're going to be going trick-or-treating. There's sort of a block near our house where kind of everyone in the town goes. The homes are, they tend to be done up more than others. And they give out full-size candy bars. So that'll be exciting.
Nice. So do you let the kids keep the candy for over the next month, or do you at some point be like, this is too much and we're going to eat the rest, we as in the parents?
I mean, we let them eat some of it. I mean, there's always more than they need, obviously. But yeah, it trickles into our stomachs over the next 6 weeks, I guess.
I know.
We'll be eating it into Thanksgiving, Christmas time,
Yes.
Yeah. And since it's Diwali, I have to ask, fireworks today? Jalebis also, or
no? So we actually celebrated Diwali a little bit earlier. A friend of ours had a party last week, precisely because it kind of coincided with Halloween. And you know how it is. I mean, the kids are going to be much more interested in Halloween than they are going to be in Diwali. So. Yeah. So we had a good time at a friend's house a week ago celebrating Diwali, and we did all the sparklers and the fireworks then. And today will sort of be a candy fest, I guess.
Yes, my daughter we did the same thing last week, and my daughter almost burnt me alive. She's terrible. Even a little sparkler, so she's like waving it around. I'm like, what are you doing? All right, Ryan, what do we got on the agenda?
Well, let's just start high level, Neil, the fun stuff. We did get Oh, that GDP number yesterday. I think it was yesterday. Everything's a blur, but solid number. I know you kind of wrote an interesting note over in Mac talking about why not to expect maybe such a strong number in the fourth quarter. You want to start with something like that?
Yeah, sure. No, I mean, the economy is resilient, but is it growing at 3% at a sustainable sort of clip? I'm somewhat skeptical of that view. I do think there's probably some downside risk, to Q4. And I think that's really a function of three things. I mean, number one is consumer spending, right? So consumer spending was breathtakingly strong in the third quarter. It ran about 3.5% at an annual rate. But as we saw this morning, in the latest sort of data on income, I mean, real incomes net of transfer payments haven't been growing as rapidly as consumer spending. So something has to give. I mean, that can only continue for so long. So I do think there's probably some risk to consumption in the fourth quarter. Second, we had a big boost from equipment spending. Now, a lot of that is a function of aircraft. So aircraft added about 0.5 percentage point to GDP. And that's been the case for the last 2 quarters. So that happened in the second and the third quarter, by the way. But given the woes that we know about Boeing, I mean, just look at the Chicago PMI for October. I mean, that's very Boeing sensitive, I would say. And, the news out of Boeing isn't good. We can expect aircraft investment to not be as strong in the fourth quarter as it's been. And then finally, defense spending had a very strong quarter. I mean, it contributed almost 90 basis points to GDP growth. Unlikely that lasts. So, it's not a collapse. It's not a recession, but it's just about positioning. I mean, there is a lot of growth enthusiasm right now. And I don't think it's entirely warranted. It doesn't mean that the economy is going to keel over or recession risks or anything like that. But it does suggest that there's probably a little bit too much enthusiasm around the economy in the market right now. And, I think there's probably some room for disappointment between now and year end. So that's kind of how I'm thinking about it. I think it might kind of push markets to maybe push the Fed to do a little bit more front loading. So, I mean, that's sort of, my take sort of on the near term data flow.
Just picking up on just Q3, but maybe even Q2, are you surprised in any way, and especially consumption, right? Because it's driven so much of it. Are you a little surprised by how strong consumption and GDP growth was in Q2 and Q3?
Yeah, it's been surprising. I mean, certainly, yeah, it's been, I mean, we had 3% of real GDP growth. I mean, a lot. And remember, it's not like total hours worked have been rising that rapidly, right? Yeah. So that means that a lot of the growth has been coming from productivity, supply side considerations, which I think is notable. But that, the implication of that, of course, is that because productivity has been growing more rapidly, that means that unit labor cost growth has been quite low. And so I think that kind of begs the question as to like, where is the inflationary impulse really in the, coming from in the economy? I mean, I don't think the GDP data on its own should be something that should alarm the Fed, because it's largely coming from supply side factors, not, basically labor force growth and, immigration, productivity. And because unit labor costs are low, I don't think the GDP number on its own should kind of push the Fed away from this policy recalibration that they've been embarking on.
So Neil, we've had ballpark 3% GDP 2 quarters in a row. You look at, incomes growing about 2% or so. I mean, where is the growth really coming from? I mean, what do you think when you peel back that onion?
And just to piggyback off of that, like we saw the savings rate, we saw a bunch of revisions. The savings rate was, revised higher. So is there room, or basically consumers drawing down savings to consume more than income?
Well, we had an upward revision to savings. That's true. And now it looks like we're drawing savings back down again. But, look, data points ebb and they flow. And, I don't know that the economy's underlying trajectory is 3%. I would tend to lean against that. We had a sub 2% quarter in the first quarter. We've had a couple of good quarters since then. And if you just take the 3 quarters and average them out, you're talking about a 2.5% growth. And that would be somewhat of a slowdown from where we were last year when the economy clocked about 3%, Q4 over Q4 in 2023. And, as I mentioned, I think there's probably room for GDP growth to not look as strong as it did in the third quarter. I mean, I would not be surprised, and I don't think anyone should be, if GDP has a 1 in front of it for Q4. So when you take a look at like what's the trend in the economy, I think it's much closer to 2 to 2.5 than 2.5 to 3. And so, that's kind of where I'm at. As I say, it's not an economy that's, falling off a cliff. It's not an economy that's, at risk of recession. I don't believe, but it's certainly not an economy that's getting away from the Fed or should make the Fed second guess its recent decision to go 50 basis points. At the end of the day, I mean, if you look at it, nominal GDP growth, right? Like if you just look at headline nominal GDP growth, it's actually been running below 5% annualized for 3 of the last 4 quarters. So that's not, right? So in some respects, the growth that we've seen in real output is really just a function of inflation coming down. And, if inflation's slowing, then, policy should be recalibrating somewhat.
So it's like every dollar, what you say is every dollar of spending is actually going to output growth as opposed to inflation.
Right. I mean, whatever doesn't go into P has to go into Q.
Right. Looking into 2025 then, beyond Q4, and thinking about how much consumption has been sustained by incomes and then drawing down savings too. At some point, do we start seeing credit grow? Like a consumer credit?
So that's one of these. So that's something I'm exploring more. And I know you're going to have Skanda come on later. But I think that's a really good discussion, because at some level, right, if they're not stimulating credit sensitive parts of the economy, what are they doing? And that eventually becomes a problem, right? I mean, it's pretty clear to me that whatever the break even rate is for the economy, or the neutral rate, whatever you want to call it, it's clearly a lot lower for the housing market. Okay. I mean, we can talk about a robust consumption and so forth, but if you look at that residential investment side of the ledger, it looks really weak at the moment. It just is. I mean, it's like,
right.
You have to, I've generally been more on the sunnier side of the mountain over the last, year and a half, 2 years. But, I don't think you can look at residential investment and sort of paint an optimistic picture at the moment. I mean, if you look at, for number one, it's clear it's contracting. It's likely to continue contracting into the fourth quarter. But if you look at the sort of sub-index or subcomponents of residential investment, it's 3 things, right? It's construction, okay? It's transactions, and it's housing renovations. Now, if you take each of those things in turn, so start with construction, right? Total starts are running below total completions,
right?
Okay, which means that units under construction will keep declining. Right. We know in the single family sector, new homes for sale that have been finished are up about 40%. So I do think it stands to reason that single family starts probably slow down as well. So there is a bit of slack growing in the single family market as well.
Family is the bulk of it. Multifamily.
Yeah, sure. But, at the end of the day, starts are running below completions. And that means that units under construction have a lot of room to keep coming down over the next quarter or two. You look at transactions, the fact that mortgage rates have jumped, that's going to weigh on housing transactions. It's just math, right? It's very difficult to make the math work if incomes are, we saw the employment cost index come out for the third quarter. It's pretty clear that wages and salaries are slowing. And so if your wage growth is, let's say, 3%, it's just difficult to make things work if the mortgage rate is 7%, right? And this is one of the reasons why, even more recently, before rates backed up, as people were betting on the 50 basis points, the Fed cutting, right? You saw some decline in mortgage rates going into the meeting. It didn't really do all that much for housing activity. Compare and contrast to what happened at the turn of the year, where people were betting on the March cut. And you saw some rebound in housing activity to go into the year. Why is that? Well, it's one thing when inflation is 2%. It's another thing when inflation's like 3.5% or 4%, right? So at lower inflation rates, lower income growth, it's just not the deal that it was before. So I think transaction activity will be weak. And that really just leaves housing renovations. You have seen some decline in HELOC rates. I mean, those are very much tied to what the Fed actually does. And so, maybe you get a little bit of renovation spending. But generally speaking, residential investment is going to look pretty sluggish, I think. And so, that to me is a problem. So, I guess how long, what I'm kind of keen on what I'm thinking more about is really how long can that situation last where you have this sort of kind of slow bleed out in housing. How long can you really sustain everything else in that kind of a situation? Because, housing is an important driver of economic growth, but more importantly, it's an important way that the Fed affects the economy, right? Because that's kind of, a very credit sensitive area. My guess is that it maybe say that it'll last so long as fiscal policy, if you continue to see the government adding to GDP growth, maybe it can continue for a while. But I do think that the housing market is going to be an ongoing disappointment for the broader economy going forward.
So
go ahead, Ryan.
Yeah, one of the questions we get, Neil, often is you've got the 10-year yield, around 430 maybe right now, and obviously 30-year mortgage is like 300 basis points more. Now that's historically a very wide range from what usually mortgages are above the 10-year yield. The question, I guess, Sonu and I get a lot. I love your take. Why is that? Why now do we have such a wide spread between what we've historically seen between the 10-year and the 30-year mortgages?
I think it really just boils down to the fact that too many people everyone's locked into low rates. And so that means that basically, it's that, and everyone expects mortgage rates to decline over the next year. So because people expect, so that means that prepayment risk is higher.
Okay.
And so as a result, spreads are higher. Meaning the 30-year to the risk-free rate, the 30-year fixed rate mortgage to the risk-free rate. So I think that's really what it comes down to. So it's almost a consequence of, I guess in some cases you can say the low rate policy of yesteryear. And because people are locked in, it just, creates these wide spreads. Now, it doesn't mean that, spreads can't come down more, but I do think that, I think for mortgage rates to come down, you have to kind of shock the system a little bit, right? If all the Fed does is what's embedded in the market, mortgage rates really won't move all that much. So they have to do something different, which is why I've been kind of talking about more front loading. And clearly, the Fed right now isn't there. I don't think it would take much for them to get there. I guess that's where I would kind of disagree with the consensus, because I do think that if you get like one clunker of a jobs number between now and year end, or, I think the Fed would probably take more seriously the risk to the job market and, do a little bit more upfront. And that could probably get mortgage rates going down, which I think would be helpful. But if all you do is just what's priced into the market, then why would mortgage rates really come down at all? It would be a very, very modest decline. And, what we know about the mortgage market is that it's, right now it looks like the sweet spot is somewhere around 5%, 5 to 5.5% for mortgage rates. And, even if you get a normalization of those spreads, it's really hard to see rates at those levels.
We really need to see the 10-year go down, basically. It seems like markets are running a lot, to your point about growth optimism.
I think so. One of the things I don't agree with is like the Fed goofed by going 50. A lot of these people would say if the Fed went 25 and 10-year yields fell, they would say, oh, look, they goofed, right? So it's sort of like classic heads I win, tails you lose type thing. But I think what's going on isn't so much the Fed goofed, it's that the markets are goofing in the sense that they're misreading the data, right? We're basically back to the sort of inflationary boom-like dynamics of last year. And I don't think that that's the underlying story for the economy. I think what we have is a soft landing. That means moderating growth and moderating inflation. So it's not, so that should, if that's right, then that should take pressure off of 10-year yields. So I think at 4.3%, which is where 10s are right now, I think there's good value in the back end of the curve.
Seems, it would seem strange to be betting on 2.5 to 3% GDP growth if housing's like a consistent 35 basis point drag.
Well, not only that, but real incomes net of transfers have basically been running very weak for the last 3-4 months. And so, not collapsing, but hardly consistent with 3.5% real consumption. But remember, housing is also an important driver of the swings in consumer spending, because so much of the consumer durables are based off housing transactions, right? You buy a house, you fill it with things, right? Appliances, home furnishings, stuff like that. And so I think it's a relevant conversation. So we'll see. But like I said, I think there's a little bit too much enthusiasm right now in the markets.
With respect to the data, are you puzzled a little bit by how strong construction employment is? I think even yesterday you picked this up. I think in a note it was there that ADP had. Setting aside whatever issues ADP has, 37,000 jobs or something like that for construction employment. And I'm curious what your take is there, like why that's seemingly strong when housing is clearly weak.
Yeah, it's a great. I've been thinking that myself. I think a lot of it is, builders generally speaking have been buying rates down, so they have activity. They have projects that they can work on, so they need people to finish the units. But at some point, the rubber does meet the road. And I say, I was talking to my friend Rick Palacios at John Burns Real Estate Consulting, but look, I think if mortgage rates are staying above 6.5% heading into the spring selling season, we're going to have issues. We're going to have issues with that, right? Because it's not like labor markets at the moment are reheating, okay? You look at quits rates, right, cycle lows. You look at employment cost index. The only thing holding up wage and salary growth at the moment appears to be state and local government workers and union workers, both of which lag. So the likelihood is that given the decline in quits, you'll continue to see slowing wage growth, which will make it more difficult for people to make down payments on, for homes, right? And so you have, so I think it's a margin squeeze for builders. So at some point they have to make some kind of deeper price concessions. They have to, or let go of workers because demand will start slowing down.
And when you say mortgage buy downs, you mean like instead of you paying a 6.5 or 7% rate?
Yeah, they buy you points with the bank to get the rate down to something that's more sustainable.
Like 5.5 or something like
that.
Right.
Yeah. I think the sweet spot is between 5 to 5.5%.
Right.
So Neil, you guys also do a podcast. I believe it's called Rinmac Off Script, weekly podcast, maybe 20, 25 minutes, comes out on Friday. Love it. It's just right to the point. You and the team talking about things. One of the things Sonu and I want to talk about, of course, the election, right? And you guys talked about this maybe 2 weeks ago, kind of the Trump trade idea, yields higher on that. You want to talk a little bit about the election or what's going on with yields? Is it a Trump trade? Is it not? What do you see out there?
Do I want to talk about the election?
Yeah, I know. Do you want to?
No, I don't ever want to talk about the election.
You guys talked about it for like 20 minutes 2 weeks ago, so I know you can't.
My running joke with our sales force is that whenever a client asks about the election, to me, it's time to wrap the meeting up because that means there's nothing else to talk about. But I think it's kind of funny, right? Because it's sort of, we had, this time 8 years ago, we had the same, cast of characters telling us that if Trump were to win, it would be bad for stocks. And now the conventional wisdom from the same group is that Trump is this inflationary demon that's bad for bonds, right? He's going to do all these tariffs and deport all these people, and that's highly inflationary. I don't know. I think when I look at it, the rise in yields has coincided with a time of, upward data momentum, right?
Yep.
generally speaking,
payrolls, retail sales.
Yeah, payrolls were stronger. Retail sales were stronger. We just saw a firmer, inflation print. We've had generally, then there's also the data drift, right? You get, claims have been low, right? We've had somewhat better consumer confidence, right? So, so there's reasons for people to expect 10-year yields to go up. So I think that to the extent that it's a Trump, and of course that's reinforced expectations of tighter monetary policy, right? Like, so it's
right.
It's it's the short circuiting effect of the Fed as well. So I am skeptical that it's a Trump trade. I mean, maybe there's some Trump premium. I mean, certainly, I think there is some of that going on. I don't want to discount it entirely, but I think people just need to really get a grip. It's pervasive in the commentary, right? I mean, and it's also like, I think we were discussing this right before the program. I mean, there is a lot of narrative projection, I think, going on, right? Like, ooh, companies are threatening to raise prices ahead of tariffs, or they're stockpiling because of potential tariffs. I mean, he's not going to be president if he wins, which is the whole thing is a coin flip, by the way. I mean, we're all talking as if it's like a foregone conclusion, which I don't think it is. But he won't be president until next January. So you're telling me they're stockpiling like months in advance? Or maybe was it a function of the port strike? Are we just going to memory hold that? I mean, the whole thing is just so bizarre. And I also think people forget the sequencing, right? I mean, last time he was the market's best friend in 2017, his first year. Every day was a headline about we're moving towards tax reform, or we're cutting 2 regulations for every one that we're putting on. I mean, it's sort of, and stocks enjoyed that. And then in 2018, things were different, right? I mean, it was a more volatile environment because I think, he basically, used the tax reform to then go out and prosecute the trade war. So, I think the sequencing is important to think about. I think the sequencing is probably going to be similar because the tax law sunsets next year. Mm-hmm. So I think he'll actually need Congress up front to get that done before he can go and unilaterally prosecute the trade war. So it's much easier to get something done with Congress in your first year because the House is all running for re-election the second year. So
I'll just jump in. Sorry, Skanda's in the blue room there. Skanda, we'll get to you. Green room, whatever color room it is. We'll get to you in a few minutes, Skanda. So we hear you and we know you're there. Go ahead, Neil. Sorry.
No, so yeah, I mean, I just, look, I mean, I think it's interesting. I mean, people look at bonds and what's going on with bonds. They're ignoring what's going on with crude oil. I mean, so it's just, I don't know. I mean, I don't think there's any. I mean, I think a lot of this is just people projecting a narrative onto the data. I think you just kind of stick with first principles. I think I saw one commentator talking about, all these negative things associated with Trump's plans, right? I mean, tariffs, tighter immigration, deficit spending, and well, if it's so bad, why are stocks generally up over this period? Like, so are you telling me like only bond investors are smart enough to price in the Trump trade, but stock investors are too stupid to? I mean, it's just, again, there's a lot of narrative projection. And I just think I think it's kind of trying to fit a mental model to the data.
Well said. I know we would definitely get Skanda in like 90 seconds. Do you have a view on 2025 yet at Renmac? Stocks, bonds, is bull market? Do you have some high level thing, or what?
I mean, I've been
connecting.
I for me, like, I'm just trying to get the next 3 to 6 months right.
Get through Tuesday.
I think, I think that's. I mean, I'm just being upfront. I mean, I think that there's a lot of things that could potentially shift, starting in the second quarter of next year. So I'm just trying to get the next 3 to 6 months right. But what I see over that 3 to 6 month period isn't exactly boom. I think it's, basically, sort of moderating growth, moderating inflation. I mean, one of the things we're seeing is unit labor costs continuing to be fairly benign. And that basically is a reminder that there's no inflationary impulse from the job market whatsoever. And if that's the case, that should continue to reinforce the Fed's, monetary policy recalibration. So I think that's kind of still the name of the game. I would be resisting the temptation to sort of bet on the Fed skipping before year end. I know that that's kind of making its way back into the conversation or the market's zeitgeist, but I really don't see it.
This is a good segue because Skanda's going to join us. We wanted to talk a little more Fed inflation with everybody. So we have, I think, a minute or two commercial or so for Skanda. Then we're going to be joined by Skanda here in a couple minutes. Chelsea, go ahead and play it.
At Carson, we're always innovating and iterating to make our offering more complete and help advisors find their freedom. And one of the new enhancements we're most excited about is our wealth management platform, which has evolved to help our advisors deliver a more personalized investment and planning experience to their clients at scale. Our investment platform and research team have grown significantly, and we're providing advisors with more flexibility to manage their investment program on their terms. We have intentionally built a wide-ranging but highly curated mix of equity, fixed income, and alternative products and managed portfolios, along with the tools, content, to power your management style and story. And we've expanded our planning offering to help our partners cover tax planning, estate planning, trusts, insurance, group retirement plans, and more. And that's just some of the ways Carson helps advisors find their freedom. Learn more at carsongroup.com.
Right.
And we are back with the middle 30 minutes of a live stream with Carson's Facts versus Feelings. I guess I'm an alien now. I'm not sure.
And the mouse came to Chicago from Cincinnati.
I can't see anything out of this, so I'm not going to ask any questions. But we are joined by Skanda from over at Employ America. Skanda, how you doing?
Good. I'm liking the costumes. I'm sorry, I'm not matching you guys in terms of level of. We got Tom Lee. I'm not sure who exactly Neil is, but looking good.
We left Neil.
I'm going as Diwali Ken. Skanda.
Diwali Ken. Okay.
I'm gonna remove this.
That's great. Well, Skanda, how about your exact title here and a little bit about what you do to help the industry? Then we'll just get into it.
Sure. So I'm the executive director at Employ America. We are a macroeconomic policy research organization. Operate as a think tank, but also as a macro research service of our own kind. So, all things Fed, markets, macro data. There's plenty to talk about, obviously, at this moment.
And have you ever talked to an alien or kin? I mean, this is different, right, Skanda?
I think I've done it a couple times, actually, now. I've talked to aliens maybe 10 years ago.
Okay. All right. Well, Sonu, I think we wanted to talk about Fed inflation. We've got two of the brightest, smartest people we deal with every day, and we're so excited both of you could join us. Sonu, fire away.
Yeah, no, we were literally just talking about the Fed with Neil. Neil was mentioning how, he's a little less optimistic, I mean, if that's a word for it, about growth. The markets and investors seem to be very positive on growth. But as a result, they seem to be, maybe we may get a skip from the Fed in December. Skanda, I know you're sort of at like 50-50. What are your expectations for cuts, basically, this November and then December too?
I think November is as close to a lock as you can assume from like Fed speak. It's pretty hard to imagine why they wouldn't go in November. December, I was probably, if you had talked to me yesterday, I would have said it's probably a 50-50 call. Today's data probably makes it a little bit easier to go in December, but there's still like room for a December pause. Just because, look, the inflation data for September was not that great. It's very plausible that October is not great. And while I think Neil and I would probably agree, like 2 months of stronger inflation data shouldn't be shaking out whatever you're planning on doing over a 3, 6, 12-month horizon. The reality is the Fed may be a little bit more data reactive and data point dependent than they like to admit.
Sure. And Neil was also, I think this conversation is online all the time. Like, wait, why should the Fed cut? GDP growth is running at 3%. Right? Like, what's your take on that? Like, pushing back against that argument. I mean, Neil has, was great at that, but I want to get your take too.
There's no GDP mandate for the Fed, right? The Fed has a mandate on maximum employment, on stable prices. Output can be strong because of stronger productivity growth, as we might want to talk about. And I'd also just warn, even though the GDP data looks very good, obviously, over the last, call it, 6 to 8 quarters, I would probably trim down my estimates for GDP growth over Q4 and Q1. I think there are enough things that are on the downside that we should be just a little bit cautious about what GDP growth is going to look like. You think about the Boeing strikes, what's going to mean for aircraft investment. If you think about what the hurricanes are likely to mean for activity in Q4, if you think about election spending actually kind of filters into some stuff. And then we have just the fact that mortgage rates are really high. Home building activity is likely to slow. It's not, keep it simple, right? It's there's probably a lot of reasons for some slowing in Q4 and Q1.
Feels like you underlined everything we just talked about for the last half an hour here.
But also unit labor costs, right? I mean, this is like sort of, I mean, for me, it feels like eerily similar to the first quarter of this year, where you had, we're kind of like right there, man, for like a March cut. And then it was strong jobs numbers that subsequently got revised away. And then, you know, sort of core inflation really firm in the first quarter. And then, you know, the Fed pushing off cuts. And, you know, frankly, that's sort of what's happened with all the September data, right? I mean, you had a strong jobs number, you've had strong inflation data, you've had strong retail sales, and now everyone's kind of going back to this inflationary boom-like dynamic. But, you know, to me, the key differentiation is that, I mean, I think even with today's data, unit labor cost growth remains benign. So where's I mean, there's no inflationary impulse whatsoever coming out of the job market. And what we know about things like employment cost index, the only things holding that up, in my opinion, are basically state and local government workers and union workers. Okay, and both of those lag. So there's probably still a pipeline of weaker compensation growth in front of us, and that to me introduces risks to consumer spending, because consumer spending has been growing like over 3.5% for the last 2 quarters. I mean, I think that's unsustainable. So, you know, to kind of reinforce Skanda's point, I mean, if you have consumption growing, let's say 2 to 2.5, and you have housing contracting, and you have investment, like residential and non-residential investment contracting, and maybe you don't get as much of an inventory story because people front-loaded everything in the third quarter, then, and you don't get another 90 bips from defense spending. I mean, so you can easily see a scenario where growth has a 1 in front of it. I mean, annualized GDP growth. And so, I don't know. I mean, I think that would spook some people. You know, I certainly, like I said, I mean, is underlying growth 3%, or are we just kind of having 2 crummy quarters around 2 good quarters, right? I mean, so we had a really weak Q1, you might have a weak Q4, and you kind of had a better spring summer quarter. I mean, that's kind of how I'm thinking about it. So I think underlying growth is still slowing. And like I mentioned, it's probably closer to 2.5 than it is 2.5. And if underlying growth is around 2.5, you're naturally going to get some quarters where you have like 1.5%.
Sure.
Yeah, I'll go one step further. I think there are ways you can get to a 0 handle for at least one of the quarters, for especially Q4. Q4, we got a lot of roll off of a lot of positive impulses. You think about not just on that election spending point, there's generally a Q4, Q1 effect after presidential election years, where you think about all the kind of campaigns and PACs and organizations and their types of spending that gets ramped up into election season. Like that tends to lead to like a little bit of a spending cliff that sort of leads to a bit of a drop off in consumer spending. So it's kind of a weird effect. But it also reflects like real activity, and you do see in like certain parts of the labor market it's being supported right now that will go away. I am surprised how resilient consumer spending has been, especially maybe the last quarter or 2 quarters. It's a surprise to the upside. I would be surprised if it continues the next 2 quarters, where consumer spending runs especially strong in the absence of some kind of real positive labor market impulse. And what I see right now is a labor market that is like, it's not in a recessionary state, but it is one in which you're seeing enough things that are slowing, right? You see enough signs that underlying job growth is slowing. Barring, I think it's weird how people went from everything is falling off a cliff in August to now thinking the labor market's obviously super strong because of one payrolls report, right? Like people need to figure out how to filter their views a little bit better. So like, otherwise we're going to have like manic takes on where the labor market is every single month. I think that the labor market's slowing in terms of wage growth. We learned that today. To Neil's point, wage growth especially slow relative to productivity growth. and this is just something that we've seen now consistently over at least 8 quarters, maybe even going on 10 quarters, where we've had now about 2 years or so of really strong productivity gains after supply shocks kind of cut the other way. And we now are in a situation where wage growth's not that hot relative to like what the productive capacity has expanded to. It's hard to see how labor market's inflationary. My only fear is there are things that are not about the labor market that push inflation month to month, quarter to quarter. So the run up in stocks in September does have some effects on inflation in October, for the Fed's purposes. It's kind of stupid, but it is something that's part of the data, and not every Fed official is like eager to parse that kind of stuff.
So let's talk about the Fed just a little bit more, maybe beat the dead horse one more time. How many cuts do you guys see coming maybe the rest of this year or even into next year? Maybe, Neil, you're going to start there. Maybe you already said it, Neil, but let's wrap it up.
So I think they'll go 25 in November, and I still have this view that they might go 50 again before year end, because I don't think the threshold is really that high. I mean, it's really, you're just betting on like a job clunker. And I know that the Fed will take that seriously. So, you know, I mean, I think the baseline is that it's 25 and 25 between now and year end. But I think by the time we get to the December meeting, I wouldn't be surprised if the markets are pricing in a higher chance of 50 than a chance of a skip. And then I think they'll probably cut once more after that in the first quarter, and then kind of wait and assess.
So that's good bit, probably like another 100 basis points or so.
Yeah, I mean, to me, that's like I think the path to the first 125 basis points should not be nearly as challenging as people are making it out to be.
Mm-hmm.
I mean, nominal growth has been running below 5% now for 3 of the last 4 quarters, right? So if the overnight Fed funds rate is above that, in my opinion, is like consistent with still a tight monetary policy. So, yeah, I mean, that's kind of where I'm at. I mean, I've generally been on the dovish side, but, look, I mean, I think to me, you have to stick with first principles. I mean, I take Skanda's point about there are things unrelated to labor market dynamics that can push inflation around from month to month, right? I mean, this sort of, imputed price stuff, and stocks have gone up, and there was something that happened with Medicare, and that's pushing up healthcare inflation. I just think this is part of the problem with this data point dependency crap that the Fed's been doing, right? I mean, they are data point dependent, which is why you've had this sort of ridiculous move up in volatility in the financial markets on all these macro data points.
Right. It's manic to what Skanda was saying.
Yeah, I just think that to me, it's like the path to the first 100 should not be this challenging. So I think it's always, you want to be data dependent. You don't want to be data point dependent, and but you also don't want to have so much forward guidance that you lock the markets in, right? I mean, that's kind of the sweet spot that the Fed's trying to navigate, right? So to me, it could be, because you don't want like the 2004 to 2006 period, right? Where you're just locked into hikes forever and everyone kind of knows what's coming irrespective of what's going on with data. But, I would just say that, look, I mean, labor markets have rebalanced. We think neutral is at most like 1.5%. And so we think that, the path to 4% Fed funds is pretty clear. So you get a little bit away from this kind of, I think, in my opinion, this kind of aggressive reaction to these macro data points.
Skanda, where do you think we'll be in, like, say, 8 months from now, like June 2025? I know that's conditioned on so many things, labor market, residual seasonality in Q1. Who knows? Maybe they'll.
Yeah, no, I'll talk all about it. I do think we have right now. My base case is it's a soft base case for two more cuts this year. I think the Fed should be cutting twice this year. It probably should be 25. But the risks are, in my view, maybe a little different from Neil's, in that I think it's probably more likely to be 0 than 50 for December, at least as it stands right now. If we find that CPI comes in really soft, maybe my judgment will change. But I think that's something that to me we're probably talking about 2 cuts this year for 50 basis points more. And then I think the challenge for the Fed is they have this sort of PTSD about Q1 running really strong with inflation. And I wouldn't be surprised to see the Fed try to use that as a pivot to say, don't get ahead of yourselves, especially talking to the market, about how quickly we're going to cut. To Neil's point, this should be a lot easier than I think the Fed will make. I think the Fed, I don't trust the Fed to make this a seamless, smooth, non-data point dependent process. Instead, I think this is going to be very cagey and tactical all the way through. But I think by the time we get to the summer, I think we can see probably another 2 to 3 cuts next year too. So we're talking about 4 to 5 cuts. How about 100, 125? I don't end up that different from Neil in that sense. But I just think the Fed has a lot. I think, in fact, Governor Waller is a very good example of this, where I think he does have a lot of sway in the committee. I think he is very easily spooked by 2 or 3 data points that run one way or the other.
He's whatever the last jobs number was.
He's basically, I think he assumes he's not doing that, but then he's like, wait, the 3-month annualized rate is where? And yeah, that can move around a lot with each month-to-month data point. And so,
I mean, given that rate outlook that you laid out, Skanda, I mean, what do you think that means for mortgages, right? I mean, because it's like, at some level, the Fed needs to juice credit-sensitive areas of the economy. I mean, if you're not doing that, like, what's the point?
Yeah, I mean, the one thing to see is like, what exactly are we going to get from mortgages post-election, right? We've had this sort of run-up in treasury yields that are potentially related to one particular electoral outcome or another. I also think some of these moves will happen and we'll just describe a political story after the fact. So whether it's Harris who wins or Trump who wins or whatever constellation of government it is, I think the odds of seeing some level of just uncertainty going down, that should be generally better for implied volatility coming down. That matters for mortgages on their own. If you see any kind of like cognizance to, hey, the U.S. economy, well, still really good, is slowing. A lot of the GDP growth dynamics that Neil and I have talked about. These are all things that should probably be tailwinds for bonds, mean lower long-term yields. So yeah, but to your point, Neil, like, does 125 get it done, right? Does 125 basis points from here get it done, or 100 basis points from here get it done? And the answer is like, I'm not sure, right? Like, I'm not sure that's true. Mortgage rates could come to outperform from here, but like, we'll see, right? We're at what, something like 6.5, 6.7, and probably you get 5.5 at least before you.
Yeah, I mean, in the first half hour, I was kind of just sort of spitballing on like, how sustainable is it for the break-even rate for housing to be substantially lower than the break-even rate for everything else?
Mm-hmm. Right.
And like, I mean, at some level, right? Like, you're going into the spring selling season with mortgage rates at like 6.5% with income slowing. I mean, that's not a good situation, I don't think, for builders, for brokers. I mean, and so I don't know. And obviously, so I do kind of worry a little bit about that because, I mean, housing is an important driver of how the Fed affects the economy.
So I'll jump in. I know, Neil, I think you've got kind of a hard stop in 10 minutes, maybe let's call it 6 or 7 minutes, give you time to breathe here, maybe change your outfit also. It's Halloween, right? So maybe quickly, you guys have a favorite Halloween movie, a favorite scary movie you like to do? And then what is one thing, maybe it's housing, but one thing that does scare you in the market? You want to start there, Skanda or Neil?
I'll give
you time to think. My favorite scary movie, I do like the slasher films. I like some of those. I think Hereditary, though, those A24 kind of the mind movies that make you think and still stick with you, make you feel just kind of creepy at the end. But the Hereditary to me is just the ultimate scary movie that it just really lives with you. And I know Sonu's a big fan of what, Sonu? We talked about yesterday. I was laughing. What's your favorite scary movie or least favorite scary movie?
I don't watch this stuff. The last one I watched, I think 25 years ago, The Ring, and I've never seen a horror movie since. Like, I'm terrified. I don't like this stuff. But are you guys into this stuff?
I'm not a big horror movie person. I mean, for me, I'm gonna go with the original Scream. I mean, that movie was a banger when I was, I guess, a teenager. I loved it. The original one. I thought that was really good.
I never really did the whole like Halloween themed movies or slasher movies. I think the ones that like the psychological thriller stuff I kind of like, but it's like not really Halloween thematic. But
Yeah.
I will say like in terms of like kind of creepy, but I'm not sure is like in like Insomnia, like a lot of stuff about Robin Williams is like the villain, and like that's what, like those sorts of movies are like ones that that's probably the closest I get in terms of horror. But I'm not really into the horror genre so much.
Yeah. Well, Neil, you need to leave. So, how about you can just end however you want to end, something that worries you, or maybe help the listeners learn more about you, about RenMac. Where can they learn more about the cool work that you guys do? And again, there's a reason we have both of you on. Neil, I think you've been on 4 times now on this. I think Libby Cantrell and you have tied for the most ever. So, thank you for that.
Good
Go
company.
ahead and a little bit and say goodbye.
Yeah. So RenMac is a firm that I've been working with for since 2012. I mean, we specialize in macro research for institutional investors and retail investors as well. We cover the sort of core pillars of macro investing, which is the economy, strategy, and fiscal monetary policy. And I cover the economics side of it, and obviously monetary policy as well. So yeah, you can always follow me on LinkedIn. You can see us on Twitter at RenMac LLC. In terms of what scares me the most, I think we talked about it. I just think that it's an unusual place for me to be more cautious than the consensus. But I do think that there's just a lot of just growth enthusiasm. Like it's sort of hooray productivity, hooray growth is 3%. I mean it's no. I don't know whether that's like sort of like it's like vote harvesting season, and so everyone's kind of like hoped up on all of this. But to me, it's just a remarkable level of complacency. Like I said, I mean, growth isn't. I mean, I don't think that recession is likely, but at the same time, it's also not clear to me that we should be sort of anticipating like a 3% growth rate forever. And I do think people are still too sanguine on the job market. I mean, yes, unemployment's come down, but we still know that consumers are telling us that job finding rates are challenging. We know that consumers don't really have the confidence to quit their jobs and search for new ones. We know that duration of unemployment's going up. So this idea that, this is sort of like this rock solid job market, I think that's kind of, I challenge the premise of that a little bit. I do think that across a variety of different metrics, the labor market does look a little bit worse than a 4.1% unemployment rate would have you believe.
All right. Well, listen, I think I just counted. We've had over 5,000 people join us the first hour, and Neil, obviously, a lot of that is because of you. So again, thank you very much.
Thanks, guys.
Are you going to wear that at your next meeting, your next Zoom call, or not? You changing? What are you doing?
No, I wore it for you guys. I feel like Ryan, you're like the odd man out. In this in this quartet of ours, but
that's all right. No.
Neil, I did tell Ryan before this, like I'm gonna make him wear a sherwani and a turban for this, but they thought maybe they'll send the wrong idea on Halloween. But next time we're together, maybe in New York or Jersey, I do want to take him for Indian food, so maybe I'll rely on you guys.
Oh yeah, reach out to me when you do that.
Yeah, he hasn't had good Indian food. I don't know if Chicago is a place for it, because I never go out for Indian food here because I think
Neil doesn't live in the part of New Jersey with the good Indian food.
No, I don't. Yeah, I live in North Jersey. I don't live in.
Talk to me.
I was able to go to Bungalow recently, which is sort of the new hot Indian restaurant in the city. So we should try to go there the next time you guys are in town.
Next time.
All right. Sure. Cool. Well, thanks, Neil. Take care, man. We'll see
Thank you. Take care.
Bye. Thanks. All right, so we are down to the final 35 minutes of our special live stream edition of Facts versus Feeling, a Halloween spooktacular. We were just joined by Neil for an hour. We just did our 4-person discussion for 30 minutes, and now, Skanda, it's up to you to bring us home the last 30 minutes. Well, we can talk about Indian food for a second. So you said you live by better Indian food than he did, or what was that at the end there?
That's right.
We'll get into it.
I live in Jersey City.
Okay.
Jersey City is good for Indian food. Central Jersey is great. Neil's a little more like in northern part of New Jersey. Not as many bases around there.
So you're going to be amidst a lot of fireworks and stuff today.
Yes. Yes.
Very nice.
But speaking of, we actually, like last conversation we were talking about like what scares you. And one thing that scares me, I think this is PTSD too. So I'll readily admit that energy prices, right? And of course, now oil's below, like WTI is below $70 a barrel. How big of a deal is that? The fact that oil prices are so low, how big of a deal is that for inflation, right? From a positive side, right? And I'm curious how you're thinking about it. And like, I think Claudia Sam, shout out to her, she's an amazing fighting cancer at this point. So she had a nice tweet this morning saying the Fed targets headline inflation. They don't target core. They use core for forecasting. So talk about all that energy and how that feeds into headline and even core, right?
Yeah, I mean, energy, some people tell you it's overrated for like long-term inflation, and there's like some truth to it. And that's why you use core for forecasting. There's a lot of stuff that energy can be really relevant for, especially when you get the bigger the energy shock, the more relevant it is, which sounds really intuitive, but actually it bleeds into more stuff, right? Think about food prices and food services prices. Where do you think your food, how do you think your food gets to the grocery store, to the restaurant? It's mostly like a function of like diesel prices. The cost of food manufacturing is very closely tied to the cost of energy. And so all of these processes, right, are a function of what's the cost of oil, gasoline, diesel. In the case of airfares, jet fuel really matters.
Sure.
Those prices all spiked really aggressively in 2021, but really 2022, right? 2022, but Russia invasion, refining capacity is in a general crunch globally at that time. And so it spiked. And there's only so much margin that like a firm at the downstream is like willing to absorb, right? If you're you can only handle so much cost, you got to push it through as much as you can, and you push as much as you can in the context of whatever demand growth will allow, right? Demand was growing pretty strong in 2021 and even 2022, less so now, right? So there's not as much room to really just push price. But I always like to bring up, like even 2008, when we were in the midst of a great recession, the financial crisis was unfolding. We also had a huge oil price shock, and it bled through even to airfares. Airfares spiked a ton in summer 2008, and only when like Lehman failed did you see the other side of it.
Right.
So like all of these sorts of energy has a huge impact on the supply side. We're probably the fact that oil prices have come down as much as they have, the fact that natural gas prices are no longer in such a shocked phase. These are all generally constructive. Think about all the prices that moved up to be able to absorb higher energy prices, but now that's just surplus. That's surplus that probably some of it generally kind of trickles out to the consumer over time, a little slower, but it's a tailwind. The longer we stay at oil prices that are not above 100, the more confident you can be about some of these commodity price disinflationary tailwinds for, let's say, food services. Think about food services is still a place where you want to see more disinflation, but we kind of are seeing it. Just like this is the underlying stuff that matters. So energy is like right now a tailwind. Hopefully it stays that way. You never know at some level, but right now pretty constructive for the inflation process. I do worry a little bit about how sustainable is it to keep oil prices at this level or lower. Just like U.S. investment, really, it's not super economical once you get below 60. Sometimes drillers get a little greedy and think that they can probably still spin a profit, but the last 15 years have suggested to be a little more cautious on that side.
Likely not, right? But go ahead, Ryan.
So we are at our final 30 minutes officially right now. Scott, I want to promote you a little bit here, because if I think about who was right from a macro backdrop the last 2.5, 3 years, I mean, literally 3 guys on this call, not me. I'm the equity guy. Maybe you say I was bullish. I was right there. But from a purely macroeconomic point of view, you and Neil nailed it, right? And obviously Sonu also. So the three of you, what was it that you looked at, let's say 2 years ago, when everyone was promising us a recession? Everyone promised, and honestly, for 2 years we've been hearing this, but you pushed back on that in a big way. And I want to make sure people understand that. That's again why we're having you on, because you've been right, and that's why we're so thrilled to hear what you've got to say about as we head into 2025. What's the high level version of why you were so right when so many were incorrect?
And I'd like to think right for the right reasons too.
Good call.
Yeah, I think think about why a soft landing. I mean, if you want to call this a soft landing, or you say it's not, we haven't achieved it yet. It's like we've gotten a lot further along in the process than where we were 2 years ago, 2.5 years ago. There's like probably two parts of the story. One is, where was the economy at that time? right? And how do you judge that? And to my mind, the economy really is ultimately about the flow of dollars through different agents between households and businesses. And my spending is your income and your spending is my income. This stuff gets recycled. We had really strong nominal income, nominal spending growth in the beginning of 2022. We had really strong throughout 2022, to be honest, right? This was much higher rates of growth than we saw pre-pandemic. That itself is like your buffer. You can think about it, right? This is like your ability to be able to absorb shocks. People talk about, financial conditions really tightened aggressively. And it's like, yeah, sometimes they can tighten really aggressively and it can spur all sorts of things. So like, be humble. But it was happening in a world in which businesses could probably still earn pretty healthy revenue growth, pretty healthy profitability. And when that's the case, you don't have to really, the cost of credit going up doesn't necessarily mean I start laying off workers in the here and now, right? Some sectors, stuff like specific tech stuff maybe got more affected because there was like lofty valuations tied to lower interest rates. But by and large, profitability tends to matter a lot for what you do with your future expenditures. That's the one part. The second is this kind of, I'd say I'm not a fan of talking about inflation in terms of inflation expectations. Not to say that expectations don't matter. Obviously, anyone who works in markets realizes expectations matter. But there is this idea that if inflation runs strong enough for like, if it lasts instead of 3 months, if it lasts a year or 2 years, it's going to become entrenched, right? It's going to become entrenched, and the only way to get that entrenched inflation out is for the unemployment rate to go up. That is a mental model that's very common among central banks. It's a very common mental model among sell-side economists. And I just think that there's not a lot of evidence for it, right? I'm not here to tell you, like, a lot of mental models we can all have, but the evidence for this sort of expectation story is not that great.
And that's PTSD from the 70s.
Well, the funny thing about the 70s is that there was not really any estimates of expectations at that time.
Oh, right.
The only thing we have are forecasters' expectations. We don't have like business expectations. We don't have households' expectations. We didn't have tips at that time. We didn't have inflation-protected securities. This is a story that was kind of made up after the fact to fit the facts. Like, well, if inflation runs strong, it can trend strong for a longer period of time. It's like things can trend strong for a long period of time in terms of inflation for a lot of reasons. In the 70s, we had multiple supply shocks. We had demographics that were very different then than they are now. So there's a lot of reasons for what happened in the 70s. But this expectation story is a really common one, right? And I don't see the evidence for that. I think what we do see the evidence for is there's a supply component to inflation, there's a demand component to inflation. We were ramping up from an economy that was off to an economy that was on and doing it at full speed. That tends to be one where you can hit the speed limit and exceed the speed limit pretty quickly, right? And so we were at that on the demand side. We were trying to get to a recovered economy very quickly. We kind of did it, but it did come with the cost of like higher rents. Rents went up very quickly, right? We're still dealing with that in the data right now in terms of rent inflation, CPI, PCE, all that stuff, even though the market rent adjustment was really all in 2021. So that's a 3-year lag. But the other side of it was there's also supply shocks. There's like a lot of supply shocks that matter. People are like, oh, Russia's just a gas station. It's like, no, there's like a lot of stuff that Russia's relevant for. I'm not here to tell you anything about geopolitical, what should be done policy-wise. But I am here to say, like, you should take care of the fact that it's a big food producer. It's a big producer of a lot of agricultural inputs. It's a big producer of a lot of, obviously, oil, refining, natural gas. This is all stuff that's really relevant, and they're all kind of globally interconnected markets. As that stuff, that was going to be inflationary. I think people kind of didn't realize how inflationary it was going to be. But as it wore off, it was going to be a tailwind for bringing inflation down. You didn't need to like lay off a bunch of people to be able to get that inflation rate down.
Right.
I think that was the other side of it, that there was a lot of supply stuff going on that people missed. Because we kind of had this one big one-time ramp on the demand side from an economy that was basically off for a bunch of cities and a bunch of parts of the country, maybe not all. And the other side of it, you had supply shocks that kind of hit the system kind of simultaneously. It's bad luck, but it also means like as those things kind of dissipate, you can get to a better outcome. Right. But that does require you to like not just take the conventional wisdom about these stories. Like, oh, once inflation gets beyond a certain point, it's like in our psychology forever and we'll never get back to it. You gotta come with a little more than that.
With respect to like now we are on the back end of that dissipating supply shock side. Speaking of, and connecting that to labor markets over the last year and thinking about, okay, what could come forward, right? One question is, do you think October payrolls will be negative? What are the odds of that? But another is slightly longer term. Over the last year, we've seen the unemployment rate go up. I've seen a lot of stories as to, or maybe that's because of supply, more immigration, and so unemployment's gone up. Do you buy into that story? I feel like you're a little skeptical of that, but I'd love for you to talk about that. And then what we could see going forward if immigration, and this has nothing to do with the presidency or who wins,
Sure.
but if that immigration supply shock is not there anymore.
Yeah. Okay. So the labor market, I think, the last 12 months requires a lot of nuance, right? Which is not sexy, but it is kind of important to unpack. Employment levels are still at very high levels, right? Employment relative to population, adjust for demographics, aging of the population, looks pretty good, right? We're at higher
prime age employment population.
Yeah, the prime age employment rate. You can take other kinds of variants. It'll tell you like we're at a we're a very like impressive level, higher than we were pre-pandemic. Great. The momentum in that has also flatlined, right? So additional job growth relative to what labor supply growth, population growth, adjusted for demographics, however you want to spin it up, has been cool. This is a similar story with wage growth, by the way, right? Like wage growth is stronger than it was 2010s, but it's also decelerating. And it's probably telling you like you should take the momentum has some signal in it as far as what the outlook looks like. So job growth is cooling. The nominal rate of labor income, the total amount of dollars that are going into every person's paycheck, that momentum is slowing. That's not a bad labor market, but it is a cooler labor market. Sure. The unemployment rate, it's a very tricky thing because historically it's been a very good indicator of recessions. Mm-hmm. But there's also something weird that was going on in the summer. We saw the unemployment rate consistently go up, even as employment itself was actually outperforming population too. What we saw was this big group of people who said they were unemployed and not in the labor, but I wasn't in the labor force before, but now I am, and I'm unemployed.
Right.
That was the change. That's a little weirder than the usual reason for why unemployment increases, which is because people lose their jobs. People lose their jobs or they're not hired into the next job. That's especially nuanced. So that wasn't happening. And so I think the Fed, I'd say rightfully recognized there's more risk when unemployment rates going up. It may be because of some of these issues regarding maybe it's immigration, maybe it's something else. I don't think we have a great answer, by the way. The data doesn't allow us to say anything with high precision, but they appropriately risk managed. They probably should have done 25 in July, 25 in September. Yeah. They kind of did it all at once. It's a little bit sloppier, but ultimately I think they got to the right outcome. But we've now seen unemployment rate come down a decent bit. I wouldn't be surprised if when we look back with revisions to seasonal adjustment, we see that actually there was a hurricane barrel effect that was pushing up unemployment for a month or two, and it wasn't actually related to labor market weakness. I will note though, the fact that the prime age employment rate has flatlined so consistently tells you job growth has slowed. And so there is a demand side to this and maybe a supply side aspect to it. I'm reluctant to jump into immigration explanations, or rather, I don't think the data is there to let us say this. And I actually kind of would chide some of my fellow economists. Look, the people have all sorts of political views about what's the right immigration policy. I think economists probably skew one way. And even regardless of how sympathetic you are or not, there's just a lack of data to be able to actually say how much immigration is happening and how it's affecting the labor market. I do find the stories given about this stuff to be kind of inconsistent. At one point, previously, we're saying non-farm payroll growth is strong because of immigration. Right. Then we said the unemployment rate's going up because of immigration. Then we were saying it's these things are very hard for me to square seriously.
Right.
And I think whatever the optimal immigration policy is, or how much people want more immigration, keep the should away from the will, or keep the should away from the description. There's prescription and description. We got to keep them separate. And to my mind, this is actually a little more mixed in that sense. If you wanted to score, let's say we have an immigration shock, what should we see? We probably should see generally stronger job growth and hours growth, which I would say we're not really seeing, but non-farm payrolls have looked on some months of the year looked very strong. But if you look under the hood, hours growth has not been as strong.
Neil mentioned that as well. Yeah.
Yeah, and so there's not as, and on the other side of it, look, if we did actually see we should see that. It would also push up consumer spending. I don't know, that's the other side of it. So the consumer spending growth has been strong. You tend to see both, right? Where it's just like it's a lot of activity. It's both supply and demand.
Right.
It could mean more supply in one place, more demand in another place. But it also shouldn't really be affecting sort of your assessment of like big macro calls too much. Like I think that's something I'd be really cautious.
It seems
about.
like it's hard to parse out anyway. So set that aside and just look at the data.
Yeah, it's really hard to parse out, and I tend to remember from my time working in the buy side itself. I think people who love to talk about like hot button political issues is a good thing to be like a little bit skeptical of. It's like everyone loves to talk. People who love to talk about politics, like try to talk about markets and economics as much as possible. Resist the temptation. Yeah. It's like there's some level of like inner discipline that I think is good.
Probably bitch casting too. So.
Yeah, there's some of that. Everyone's got their biases here, so it's like
that was a great discussion there. You know, it is Halloween. We're doing this, and I just glanced over. S&P's down 1.5%, and then just for fun, I was looking, and I know this stuff's random. There's the Tom Lee mask that Sonu's wearing.
Like
just
to rally.
Just for fun. Again, it's random. I get it, but hey, it's Halloween. This is we had a 2.5% drop on Halloween of 2011, so that was still kind of the debt downgrade and some of the European issues back then. That's like the worst one. Okay, 1978, the year Sonu and I were born, down 2%. So this is one of the worst Halloweens stocks have ever seen. Random, sure, but hey, it's the spooky day. Skanda, how much do we have? We've got about 15 minutes. The one thing that I know you've been all over is the idea of productivity. I know you've kind of talked about it a little bit over the past 45 minutes you've been here, but that was one of your big calls, was we're going to see probably some stronger productivity in our country, and that has been playing out. And honestly, when you were talking about that a year and a half, 2 years ago, whenever it was, Sonu was talking about, you were pointing it out. I don't recall too many other people saying this
Skanda stuff, so I've Skanda for a while.
So again, congrats on that call. But why did you think we'd have a stronger productivity? Again, everyone sees it now. Everybody, productivity's higher. You were on that way before anybody else. But where do you see it going? Can it still remain kind of above trend into 2025?
And I'll just plug Skanda's piece from yesterday. I think it's breaking out of stagnation, but go ahead.
Yeah, so this is a call I am quite proud of. I think some people did not foresee that productivity growth could have a strong rebound. And look, right now we're running at a productivity growth rate. Once you account for Q3 data, all the revisions, we're doing much better than we were doing pre-pandemic. And that's like 2% annualized versus something like 1.4 or 1.5 charitably is like a pretty big difference. And I think a big chunk of that to me was, so there are 3 parts of productivity. I try to take a data-driven view of this rather than hey, I hear about this technology, therefore it must be relevant, right? There's a lot of people who are like eager to say it's AI, right? It's like, I'm sure AI is going to matter, but Comet days, is this going to be stuff that's going to matter over the next few years more so than the last 5 years? And there were a few, if I were to break out into 3 causes that really matter for productivity outcomes, the data. One is the labor market. The labor market really matters. Productivity has this weird quirk where it spikes during recessions because it's easier to shed labor quickly. But that tends to be very empty calorie type productivity gains.
That's the productivity increase you see during recessions.
Yeah, it's fake, right? This stuff tends to reverse out and actually tends to underwhelm subsequently. We've gone through that spike and decline, and now we've seen a resurgence, right? So employment levels are higher than they were pre-pandemic. And so how do you reconcile that? And I think the real part of that, if you look through the last 30, 40 years of data, we tend to see higher rates of productivity growth follow higher levels of prime age employment, of employment generally. So when a tighter labor market in general tends to be supportive, I'd say through what I'd call the experience dividend, right? People who are trained up, who are in a job, are more likely to be able to do more a year from now, 2 years from now, right? So you don't need to bring in the extra worker to get the extra bit of revenue. train up that same worker, that worker can help you generate more revenue growth over time. That's what I think every person who is making a hiring decision is hoping for. I hired this person today. I'm taking a little bit of cash flow here today, but that person's going to be trained up with skills, experience, training, and then a year from now, 2 years from now, we're trying to scale up revenue, sales. That's going to translate, right? I can see Ryan nodding along, right? This is the general calculation. Right? So this is
points. I know you have a couple of more points, but on this labor market topic, I think generally, like I was at a client event last week, and like we have amazing advisors and their clients, and one of them was like, they're talking about the AI story when I talk about productivity, and they said like AI is yet to come, that maybe icing on the cake, cherry, however you think about it. It's not here yet, at least on the data. But the fear is, with a lot of AI or productivity, we'll get layoffs, things like that. But what you're saying is almost like the opposite. You need a strong labor market, and then productivity is downstream almost of that, right? And then the other thing people usually say, the labor market is strong, so workers are too expensive, and that's how you get productivity growth, because companies have to invest in technology, things like that. But that's not quite how you see it, right?
I mean, I think the notion of automation capex, because labor market's tight, is a nice story, and I think it can be episodically true. It might even be true right now. But I'd say, just in terms of if I take a retrospective view of the data, if I were telling you what I was seeing and thinking in 2023, early 2023, I was probably thinking more about the experience dividend, right? That's the main thing that I think people miss. It's not I think going forward, the labor market's a lot tighter now than it was in the 2010s or 2000s. And because of that, I think firms are going to have to think about how are you going to be able to sort of right size your workforce, the cost of your workforce, what you get in terms of payoff. And that's going to mean maybe more investment in software, hardware, machinery, equipment in various ways. So that is like something I see as a big chunk of how the labor market actually ends up being supportive of productivity growth. If you think about the 2010s, right, productivity growth stunk. So did the labor market in a lot of ways, right? The labor market was really sluggish. I'll put it that way, right? We're coming out of the recession, a lot of deleveraging, like economic momentum was just not great. And so you don't have a lot of workers who have a lot of experience to be able to scale up. And the other part of it is also demand, right? Like if you're going to scale up when you anticipate some level of robust demand growth. In this environment, we do have more demand growth supported by wage growth than we did in the 2010s. In 2010s, demand growth was supported by job growth. Obviously, when you get a job, you earn more income. When you get a job, also when you get more income, you spend more. But that's like also being kind of offset by there's constantly this churn of more job growth because we're coming from a low base. So when you get to a higher base, hours growth is going to be slower generally, right? Hours growth tends to be strongest when the labor market is slack, and hours growth tends to be slowest when outside of recessions, obviously, when employment levels are high. I think it's really a foundational thing. We've seen this now in the late 1990s. You saw this happen in 2019 too. So 2019, I'd say, was a labor market that was pretty strong. And you did see productivity numbers with some benefit of revisions in hindsight was actually quite good. And you're seeing it right now over the last like two and a half years now, right? Where we've seen this productivity turnaround. And I think that's one big part of it. The other thing we talked about earlier, there were a lot of shocks related to supply chains, commodity prices that have dissipated or reversed. That's also been a really nice tailwind.
Sure.
And with the benefit of revisions in September, we now see investment stronger. So we saw GDP revised up over the last few years by about 1.5%. And that was driven a lot by, hey, actually, we have more investment going on in the economy than we realize. It's in aerospace, it's in industrial equipment, it's in semiconductors, chips, research and development.
Let me just jump in, because this is one of the questions we had. Sorry, I know, but this is where you're going. We've had all this manufacturing construction. I mean, you've been all over it, Sonu's been all over it. It's been huge, but eventually there has to be a handoff. And I think we're getting close, because some of the recent construction, maybe we're hitting that peak. How tough will that be? Because, okay, we've built it, right? We've built these chip facilities. We've built all this stuff out there. But now you need to actually do something with everything you've built. And productivity is supposed to come. Listen, we all watch a lot of sports. Sometimes a simple handoff can be a disaster. And I'm not saying it's going to be, but talk about that transition from building it to actually creating with it.
Yeah, so I think of these as phases, right? So we have the first phase is the construction of the facilities, the factories, the manufacturing plant expenditures. The next phase, I'd actually would say before you get to the production side is you got to have the equipment inside it, right? You got to have the machinery. And so
right.
we're starting to see that in a few different places. The revisions to GDP and the latest GDP release suggests industrial equipment is starting to ramp. We're starting to see that in the production data too. There's a high production of electrical equipment, and that's also accelerating. There are some bottlenecks that might be getting in the way there. There's a lot of talk about a transformer shortage. But we do know that utilities intend to invest aggressively right now. You obviously had that Constellation Energy announcement with Microsoft, but in general, there's also just a lot of blocking and tackling type investments that the utility sector has to do, and we're likely in the midst of a bit of capex super cycle there. As you scale that up, then to your point, we should be seeing like both employment increase, obviously like more OPEX type ramp there, and so you should see hiring in certain parts of manufacturing, maybe parts of utilities as well, and production's got to come through. I will say I'm encouraged to see, especially in the place where we've seen this sort of causal chain kind of play out already, is in that sort of semiconductors, information processing equipment side. So we've seen industrial capacity estimates have really increased and improved quite meaningfully. We're seeing production also start to show some acceleration. It's probably gonna take some time still, because a lot of these facilities have just been built or are still being built. These things are pretty complex. They tend to take a long time for a variety of reasons. But we're seeing some of that. I think you just want to see that show up in more places and more at the top line level across not just some like small subsectors, but ideally really shows up as stronger capital goods investment, stronger manufacturing production in those key sectors. The sectors that are really relevant here are about electronics and electrical equipment, right? So you're talking about everything like goes into computers, everything that goes into chips, as well as everything that kind of goes into stuff like batteries and all the stuff that the utility sector uses in terms of machinery.
Well, we've got about 5 minutes. Sonu, probably the last question for you, then one more for me. So let's make it good.
Yeah, actually, just tying to that same productivity and investment over here, I was staying on that theme. How important is fiscal here? And even you wrote about this in your piece yesterday, both recent fiscal policy, whether it's IRA, CHIPS, all of that, CHIPS Act, but even going back to the Trump, the TCJA, or Tax Cuts and Jobs Act, which former President Trump signed into law in 2017, seems like that's played a role. And I have to bring up, like, what's going on with Boeing and Intel?
Yeah, these are that's a lot to chew off there, but I think that there's been a lot of support in various ways for investment, right? We made sure the COVID recession wasn't going to have the sort of long-term scarring that, say, the financial crisis had. That was a policy choice. It was also a different recession, but it's both. There is just the fact that we did a lot of these sort of big public investment programs, some of them bipartisan, like bipartisan infrastructure law, CHIPS, some of the stuff more partisan, TCJA and the Inflation Reduction Act. I think they've all had their place in supporting sort of a strong U.S. economic environment, stronger investment outcomes in general. So that's all very encouraging. How much of that sticks beyond? I will admit, and this is probably, I have a hard time seeing how we're going to get a lot of new fiscal impulses from here, but it may not be as necessary either. We're kind of in a different state of the economy where probably more focus needs to be paid to making sure these laws that are implemented, or these laws that have been passed, are implemented really well, that they're crowding in the right kind of investment. And I think at this point, look, we probably have a big tax policy fight no matter what happens next week. So that might change some of the contours of certain outcomes. But on the whole, I would say there's a lot of room to be optimistic about investment sort of staying strong structurally. I think that's where I think Neil, we had earlier, and myself, we're not kind of consistent like recessionistas. So we're probably cautious about the outlook for the next 6 months. I would say in general, I'm quite optimistic, though. I think this, like all things considered, this is a hand you should want, not a hand you should want to play. You want an economy that it has the current features, rather than an economy that is digging itself out of some big shock. And this is a setup that it should be pretty favorable. There are ways the Fed might screw it up. There might be other shocks that hit the system, but you should be generally pretty pleased with the fact that we have an economy of strong growth, high employment, falling inflation.
I think that's probably a pretty darn good way to kind of end, the macro discussion is on a high note. I love it. So tell us a little bit more here, Skanda, for the listeners on a little bit about Employ America, maybe even a little bit more about you, but how the listeners can learn more about the incredible work you and your team are doing out there.
Sure. So Employ America is both, we have a public facing, our main mission is it's like a think tank of sorts. So we provide research reports, all that kind of stuff. But for those who are specifically interested in navigating all of the data points that are out there, the high frequency economic data that the Fed inevitably overreacts to or underreacts to at certain points, we do that. We do that on a high frequency basis for our subscribers. It's called Macro Suite. You can find it on our website, employamerica.org, pretty easily, and we'd be happy to get you connected. And we try to be as supportive of our subscribers to make sure that they are able to access our research and able to really get the best view, bottoms up, all the blocking and tackling that goes with U.S. macro. And so we were very happy to do that. And it's been, I think from our relationship with Sonu and yourself, Ryan, I think we hopefully have had a very fruitful relationship.
Yeah, I think
ask if the Fed subscribes, but no, you don't have to answer that.
Yeah, we always have to be careful. Like, we live in a world of managing money. Like, do we recommend something? Well, of course, we're fans because you're on here. I got to be careful how we're saying it. But let's just say we like what your team does. I got to be careful what I say, not to get dinged by compliance. But wink, wink, we really like what your team is out there. We'll leave it at that. So, any final comments, and let's wrap this thing up.
No, this is fantastic. I mean, you said, I think you've said you're optimistic. It's just that it seems like we just have to get over the next 3 to 6 months, right? Any big data points you're looking for? I mean, not that you're data point dependent, but the market is. It looks like so. What's the big one?
Okay. I
mean, payrolls.
I'll give you 3 small ones. So I'll say like payrolls. It seems to me that consensus is too high. It maybe we outperform. I generally don't like forecasting payrolls because I don't think that a lot of people have edge there. Mm-hmm. But I don't think people are going to care if it misses. I think that's also true. And so I don't know what you do with that view exactly. But on the CPI, PCE implications for October, that could be on the strong side. I think especially some of these data quirks that we try to share with our subscribers to Macro Suite, we try to really dig into why inflation's moving higher or lower in a given month. And there are some things that are probably on the stronger side that we'd be a little bit cautious about. That probably does shape some of what the Fed might be willing to do in December. And so in strong inflation, softer payrolls. Sorry.
Oh,
as confusing for the Fed as it probably will get.
Yeah.
That was good. We probably could go all day, but we're not going to. We said we're going to go 90 minutes, and we've got a pretty hard 90 minutes. So listen, thank you so much, Skanda. Thank you to Neil as well for joining earlier. Thank you to everyone on the Carson team that helps put this together. Obviously, our producer, Chelsea, has been pushing all the buttons behind the scenes to make sure that this whole thing goes off without a hitch. With all of that, everyone, thank you for, especially, I mean, we had over 5,000 people, so I'm sure a few of you were here the whole 90 minutes. So thank you so much for joining us for a very special live stream edition of Facts versus Feelings, Halloween Spectacular Spooky Day. Hope everyone has a happy and safe Halloween later this evening. And Diwali, is that
Diwali? Yeah, Diwali. And stay safe with the fireworks for those.
Yeah, watch those fingers out there. So I think with that, we're going to sign off. Thank you again, Skanda. You guys are awesome. We're just appreciate everything you guys do for the industry, and we're fans. So Chelsea, I think with that, we can probably play the going away commercial. Thanks, everybody. Take care.
Thank you.
Thank you.
Carson's helped me find my freedom by just reinventing who we are. It's been a journey of just being a solo practitioner, going to an ensemble practice, and actually being able to look at the firm and the practice and my life and be able to do exactly what I want to do. Not ever thinking about stepping away, but being able to continue to grow and help change other people's lives, both professionally and other advisors.